Welcome to this explainer. Today, we're putting on our portfolio manager hats and doing a complete, under-the-hood diagnostic of Bitcoin's latest market movements. It's incredibly easy to get swept up in the total euphoria of big headline numbers. We've all been there. But our job today is to look right past that noise and diagnose the actual mechanical forces driving the price. We need to understand the structural health of this rally so we can make informed, strategic decisions.
Here's our roadmap for today's deep dive. First, the 80K breakout. Second, spot versus futures demand. Third, echoes of March 2022. And finally, key support and entry risks. Okay, let's jump right into part one, the 80K breakout. So let's talk about the elephant in the room, $80,000. It is a massive psychological and technical threshold, and the recent price action around it has generated a ton of excitement. We actually saw Bitcoin push past this mark, peaking all the way above $82,000 before macroeconomic reality kind of tapped the brakes. We got a hot producer price index, or PPI print, and the asset slipped back down to the $79,500 range. But here's the thing. The real story isn't just that Bitcoin crossed 80,000, it's exactly how it got there, and more importantly, who was actually doing the buying. To diagnose exactly who is driving this market, we rely heavily on a specific metric called the Coinbase premium. Simply put, this is the price gap between Bitcoin traded on Coinbase versus what it's trading for on offshore exchanges. Now, why does this matter to us? Well, Coinbase is essentially the primary on-ramp for U.S. institutional capital. Typically, when we're in a strong, really sustainable bullish trend, we see a positive Coinbase premium. That tells us U.S. spot buyers, the institutional heavyweights, are actively accumulating and basically outpacing the rest of the world. So, what happens when that premium flips? Well, that's the kicker. On April 29th, the Coinbase premium actually turned negative. And it stayed negative right straight through this recent 5% rally above 80K. A negative premium means offshore traders are literally paying more for Bitcoin than U.S. investors are willing to pay. To give you some context on why this is a red flag, when this negative flip happened on April 29th, it coincided with a massive $5.97 billion spike in realized losses. Basically, underwater holders were using this rally as an exit liquidity event. They were selling right into the upward momentum, while U.S. spot buyers completely took a back seat. Which brings us to part two, spot versus futures demand. Right, so if U.S. spot buyers aren't the ones driving the bus right now, we really need to look under the hood and figure out what forces are pushing the price upward. This is absolutely crucial for assessing your portfolio risk. On one side, you have U.S. spot buyers who are currently signaling weakness thanks to that negative Coinbase premium we just talked about. We generally consider spot accumulation to be a really solid foundation. When institutions buy spot, those assets usually just sit quietly in cold storage for a long time. But on the other side, stepping in to fill the void, we have offshore leverage traders. They're driving the price using perpetual futures. It's kind of like building a house on shifting sand rather than a concrete slab. Let's quantify that weakness in the spot market with a look at on-chain apparent demand. This metric basically measures how much new Bitcoin is being absorbed by the market relative to the new coins being mined and old supply waking up to be sold. Right now, it sits at negative 11,000 Bitcoin. Now, to be fair to the bulls, this is actually a massive improvement from the heavy supply overhang we saw back in April, when this number was sitting at a staggering negative 91,000. So the market is definitely nearing a balance, but the fact remains, it's still negative. Spot absorption is just falling short of meeting those supply-side pressures. So if real, unleveraged spot demand is lagging, we have to talk about the vehicle that is driving this market right now, perpetual futures. If you aren't familiar, these are futures contracts without an expiration date. They allow traders to hold leveraged bullish or bearish bets, and they use funding payments to keep the contract price tethered to the actual spot price. Now, speaking as an advisor, the word leverage always makes me pause. Yes, for sure, leverage absolutely magnifies gains on the way up, giving us those explosive headlines. But it carries tremendous risk. A rally built entirely on futures is just inherently fragile. Let's move on to part three, echoes of March 2022. Understanding exactly where we are in a market cycle usually requires looking back at where we've been, and this comparison perfectly illustrates the structural parallels we're dealing with today. Look at these numbers from CryptoQuant. Back in March 2022, Bitcoin rallied an impressive 43% from its lows. Today, we're looking at a 37% rally from the April lows. Pretty similar, right? But the percentage isn't even the most important part here. It's the underlying structural signature. In 2022, that rally stalled out right near its 200-day moving average and eventually went right back into a downtrend. And currently, unrealized profit margins are sitting at the exact same levels we saw right before that 2022 rally stall. Actually, let's look at the exact takeaway from the analysts at CryptoQuant, because they hit the nail on the head. They noted that the current setup has the structural signature of a relief bounce rather than a fresh accumulation phase. As an investor, this is a massive distinction for your portfolio strategy. A fresh accumulation phase, that implies a durable, long-term bull run, backed by real spot buying. A relief bounce, on the other hand, is just a temporary upward correction in a wider, uncertain market. It's driven by leverage that can unwind just as violently as it built up. Finally, part 4, key support and entry risks.
So, taking all this data, how do we actually translate this diagnostic into an actionable strategy? Well, if this current futures-led rally starts to fade, the absolutely critical line in the sand we're watching is $70,000. On-chain data identifies this specific price as the trader's on-chain realized price. To put that in plain English, $70K is the average cost basis of the short-term traders operating in the market right now. It's what they paid. Now, why should you care about their cost basis? It all comes down to market psychology and structural incentives. If the price drops back to $70,000, the unrealized profit margins for all these short-term traders basically compress down to zero. They're breaking even. And when traders hit their break-even point, the panic to aggressively take profits and sell, it just evaporates. This creates a psychological and really a mathematical safety net. It makes 70,000 the most likely level of robust support if this 80,000 resistance proves too tough to crack.
Let's pull this all together and build out our risk profile for anyone thinking about allocating capital today. If you're looking to enter the market right now, you absolutely must weigh these 4 concrete risks. First, funding rate flips. If the cost to hold these leveraged long positions gets too high, traders are going to abandon ship. Second, liquidation cascades. When leverage is high, even a small price drop can trigger automatic sell-offs, causing a rapid, terrifying domino effect downwards. Third, we still have weak spot absorption. The organic, unleveraged demand just isn't quite strong enough yet to soak up heavy selling pressure. And lastly, the historical fragility of futures-led rallies. History loudly tells us that they simply don't last as long as spot-driven ones.
So we've looked under the hood, we've bypassed all the headline hype, and we've diagnosed the structural reality of what's actually happening out there. U.S. institutional buyers are currently sitting on the sidelines, offshore leverage has taken the wheel, and history is flashing a pretty bright warning sign. All of which leaves us with the single most important question you need to ask yourself today. Is your portfolio truly prepared for a retest of the $70,000 support level? Thank you so much for joining me for this explainer. Keep your risk strictly managed, stay focused on the data, and I'll see you next time.